Well, not a good week so far on the markets. Earlier I spoke to Ken Howard, a client advisor with RBS Morgans. Well, Ken Howard, another slide that's 4 on the trot. So are we seeing an extension of the so-called buyer's strike?
I think so, but not for terribly much longer. If you were to take a look at the big banks, ANZ and Westpac are now starting to approach the levels they were trading at during March, May last year, when the Greek crisis first reared its head. So some of those stocks, like the big banks, are starting to reach that dividend support level, 7% fully franked type of number, where I think the market will start to find its bottom around this level, the 4,500 type of mark, which has been the bottom end of the range for the last 12 months.
You mentioned the banks. Macquarie Group is at new lows. What do you make of that?
Yes, look, the merchant banks globally have all had a very tough couple of years, and it looks like it's going to continue. Macquarie Bank is also representing very good value in our mind, trading around 1 times book value. But it's hard to see where the corporate activity is going to come from, where the IPOs are going to come from to drive their revenue and drive their profitability in the short term. So it's likely to be another soft year for Macquarie Bank, but certainly representing very good value for anybody who wants to play a longer-term recovery in financial markets.
And finally, in a market that seems to have gone sideways over the last 18 months, what investment strategies seem to be now working?
Well, the one strategy that I've been promoting to clients today has been the dividend yield strategy. I mentioned the big banks starting to approach that 7% fully franked level. You've got Telstra that's still trading around close to 10% fully franked. If the market's going to continue to move sideways, then getting a dividend that's grossed up 10, 11, 12%, when you include those franking credits, is going to be a pretty competitive return in the market that we've had over the last 12 months, certainly. And it's hard to see where the confidence will come from in the next 12 months to see a lot of growth out of the market. So
what if it moves
the dividend
down?
Yield strategy, the market moving down?
Yes.
Yeah, sure. That's always a possibility. But when you look at how the market has traded over the last couple of years, we had the Greek crisis last year where there was a lot of anxiety, and 4,500 seemed to be the level for the market. When you look at what investors can do with their money, they can leave it in cash, maybe earn 5 or 6%. They could buy Telstra shares, for example, earn 14%. There's a pretty compelling case already for investors to go out there and buy equities. So, look, the market might have a bit more downside, but if the corporate profits are there, then the dividends will be there. And if the dividends are there, then there's the attraction for investors to come forward and buy equities, because the Australian economy is actually strong. We've got growth in the US, we've got growth in Europe, we've got very strong growth coming out of Asia. Australia's doing well. It's really a sentiment issue that's missing as far as the share market's concerned, not the underlying fundamentals.
Ken Howard, thank you very much for joining Late Line Business.
Thank you, Tiki.